I think in terms of risk reward and preservation, gold is by far, and we're talking for investors now,
Sure.
by far the most valuable resource to have. Stagflationary periods, both in the US, but also from studies of stagflationary periods around the world, gold tends to do well because your currency tends to do badly. So if a currency does badly, gold tends to do well. Gold stocks tend to do well. Gold stocks, contrary to what one might think, tend to do well in recession.
The recent economic turmoil caused by high inflation, back-to-back interest rate hikes, and a string of regional bank collapses has taken a toll on many investors' portfolios. In turn, more and more investors are turning to precious metals and gold to add stability to their portfolios. Adrian Day, president of Adrian Day Asset Management, believes that gold is the best and most valuable resource. Financial markets have seen heightened volatility during stagflationary periods, while gold has fared well. Historical data reveals that investment portfolios have benefited from gold's attractive returns during such periods. Adrian points out that this is because, during such times, the currency's value tends to decline. In contrast, gold's value tends to rise. Adrian describes gold as a chameleon investment because it acts as a hedge against various risks, offering protection against inflation and deflation. This versatility makes it a compelling choice for investors seeking stability and risk diversification. In a recent interview, Adrian expresses concerns about the current state of global stock markets, including major markets such as the US. He views these markets as overvalued, which might signal potential risks for investors. Additionally, bond markets have been in a prolonged bullish cycle spanning approximately 4 decades. Given this extended period of growth, he cautions against investing in bonds as they might be vulnerable to a downturn. Conversely, Adrian identifies gold stocks as remarkably undervalued, with major producers of gold and silver trading at valuations close to their lowest levels in 2 decades. This starkly contrasts the relatively high price of gold itself, making gold-related stocks an intriguing prospect for investors seeking undervalued assets. Now watch clips from Adrian Day's interview with David Lin. Please watch the entire video and consider subscribing to our channel. Remember to turn on post notifications so you get all our uploads. Thanks, and enjoy the video.
Gold is typically, I call gold a chameleon investment because it hedges you against a lot of different risks, some of which are contrary.
Sure.
So inflation is one and deflation is another. Gold has actually performed better during deflations on a historic basis. It's performed better during deflations than it has during inflationary periods.
Sure.
In real terms. So gold tends to do well during stagflationary periods. The gold stocks do well. Oil, other commodities tend to do well. Smaller markets tend to do well. Emerging markets are small. I don't like to say emerging markets because now emerging markets are some pretty weird and wonderful markets. But let's say smaller markets tend to do better. And what does badly during stagflations are developed markets, US and other major markets around the world, stocks and bonds. They tend to be the worst performing assets of all in stagflations.
Right.
And that scenario matches very well where I see overvaluation and undervaluation today. I see global stock markets, major markets, as very overvalued. Not just the US, but other major markets as well are overvalued. Bonds are at the end of a 40-year bull market. Bond markets tend to be very long. The cycles tend to be very long. So they peaked, the yields peaked, so the bonds bottomed in 1980, and then the time before that was like 1950, 52 or something. So we have these 30, 35, 40-year cycles in bonds, and that's historically true. So bonds are at the end of a bull market cycle. I don't want to be investing in bonds.
Yeah.
And yet on the other side, gold stocks are incredibly cheap. With the XAU, the major gold and silver producers, selling close to their 20-year lows in valuations, even though the price of gold is at 1950.
Sure.
Commodities, you look at the whole commodity index versus the S&P, we're basically at 100-year lows. We're not saying the commodity prices are at lows, but relative to the S&P, they're basically 100-year lows. So the stagflationary and the assets that do well in stagflationary periods happen to be the ones that are the most undervalued right now. And of course, the emerging market stocks have done very badly for the last 10 years compared with the major market.
Adrian believes the economy is heading toward a period of recession, which means there will be a slowdown in economic growth. During this time, inflation will persist and prices for goods and services will continue to increase. Adrian predicts that by the end of the year, inflation rates may reach around 3.25% to 4%, which could become the new norm for a while, impacting the cost of living and the overall economic environment. After resuming its monetary tightening campaign this week, the Federal Reserve is poised to leave the door open for another interest rate increase. Officials at the Federal Reserve are currently debating how much more they should throttle economic activity to control inflation. In June, the last time these predictions were published, officials projected a slower descent this year towards the Fed's 2% inflation target, with the core personal consumption expenditures price index expected to register an annual 3.9% pace, up from the previous estimate of 3.6% in March. Based on a more positive growth outlook, most officials considered 0.5 percentage point more monetary tightening this year to raise the Fed funds rate to a peak of between 5.5% and 5.75%. Adrian believes another financial crisis, such as more bank failures or issues with pension funds and insurance companies, might cause the Fed to pivot its approach. Let's get back to the interview.
So, I agree completely. You didn't say it. I agree completely that we're heading into a recession. All of the indicators are showing that, whether you're looking at the leading economic index of the Conference Board, whether you're looking at the yield curve. The 3-month, 10-year is the most inverted it's been in, 40 years or something. I think we're heading into a stagflation, and I think we're heading into a stagflation because, to me, a recession is baked in the cake right now. I'm not talking about a 1930s-style depression, but just an economic slowdown is baked into the cake, and yet we're going to continue with inflation. Inflation's going to be stubborn. So right now we're going through a sort of respite in the inflation rate. Part of that is because the oil prices come down, and that feeds into everything, had come down. And part of that, of course, is the base effect. We're now comparing this month's inflation to last year's June, and so on. And so the comparisons are a lot easier. If you look at, as we go a little bit forward, like 6 months from now, those comparisons are going to start to get more difficult again. Right? Number one. Number two, if the oil price reverses and moves back up, which it seems to be doing, not today, but it seems to be doing, that feeds through into everything. It feeds through into transportation. It feeds through into the prices of goods in stores that have to be, shipped around. And so by the end of the year, I wouldn't be surprised if we see 3.25%, 3.5% headline inflation, maybe 4%, and that will be the sort of new norm for a little while. Much about the market. What will cause the Fed to pivot, in my mind, will be another financial crisis of some type, whether it's more banks failing, or whether it's pension funds, or whether it's insurance companies. People seem blasé. Not the stock market, incidentally. The stock market has priced in the risk in insurance companies. But, people don't talk about insurance companies going bankrupt. Now, you have some major insurance companies say they cannot afford to meet their liabilities. The Fed's going to step in. There's no question. Well, generally speaking, just increasing interest rates does control the supply side as well, because it makes returns less less positive.
Yes.
And so people don't invest so much and don't produce so much.
Right.
But, I think the Fed has gone just about as far as it can on interest rates. I'm not saying they're going to start cutting rates anytime soon, and I still think we probably have 2 more. The one later this month is kind of baked into the cake, I think.
Gold could reach new all-time highs in the coming years as inflation continues to rise and the global economy weakens. If inflation continues to increase and the global economy weakens, gold could reach new all-time highs. Do you believe investing in gold can stabilize your portfolio during economic turbulence and inflation? Please share your thoughts and observations in the comments section below. If you found this video informative, remember to give it a thumbs up, subscribe to our channel, and enable notifications to stay informed about our latest videos on silver, gold, and copper. Thank you for watching, and we appreciate your support.